Good morning. It's Jeffrey Christian of CPM Group. It's about 10:15 in the morning on Friday, the 11th of July here in New York. Gold, silver, platinum, and palladium prices rose very sharply overnight and this morning, while the stock markets were off in Japan, Europe, and then in the U.S. pre-market. And copper declined sharply, about 9 cents. The occasion for the price increase seems to have been just sort of an investor concern or a heightened risk off type of response to some of the continuing and perhaps worsening chaos that we're seeing in the political world, especially in Washington, but also on a global basis. So, we've seen the Trump administration make threats that it would increase tariffs on Brazil if Brazil pursued criminal proceedings against former President Bolsonaro. He's also threatening increased tariffs on Canadian goods based on his own personal grudges and political views. He's hiked up copper tariffs, which have caused copper prices to rise sharply until today. Then there are all sorts of issues with the big, beautiful budget bill. There are signs of all kinds of things that don't work with it. There are increasing concerns among Republican Congresspeople who voted for it. Importantly, and I think I've mentioned this in the past, a lot of the cutbacks and reductions in services and government activity have been scheduled to only come into effect after the 2026 congressional election. The Republicans who put this together knew that if those policies were put into effect now, they probably wouldn't be reelected next year. So the pain has been delayed for well over a year and a half there. So you have a lot of issues. Then you have a court in New Hampshire saying that the Trump administration cannot abrogate the 14th Amendment of the Constitution on birthright citizenship and structuring its ruling in such a way to require the Supreme Court to address that specific aspect of that issue. The Supreme Court, meanwhile, gave the Trump administration the green light to go ahead and start mass firings. So there's a lot of chaos there. And for some reason, people were surprised by it. Markets were surprised by it. We don't understand what wasn't understood before yesterday. But the bottom line is that we saw a ratcheting up in precious metals prices today. We issued a silver ultra short term recommendation for silver to our clients yesterday, saying that we thought the price could spike up to $38. It got up to $38.40 something this morning. So it's there. I want to talk a little bit about the precious metals markets today, and then I also want to talk a little bit about the dollar and gold. Gold prices, as I said, they spiked higher 43 just before we put this together. The gold price was up $43.40 from yesterday's close. It was $3,369. We have been saying that we thought it would go back up and test $3,450 over the last few weeks. It hasn't yet, but we wouldn't be surprised to see further increases in the gold price over the next 2 weeks as we approach the first delivery date for the active August COMEX gold futures contract. In addition to that, you are seeing investment demand, especially for 100-ounce bars and gold ETFs, on the part of institutional investors, high net worth individuals, and other investors. So given the economic and political environment, we think that the price still moves higher, probably over the next couple of weeks going into August delivery. Silver prices were up $1.89 when we put this together. They had reached $38.48, 49 cents. Again, we're testing that level there. Most of the July open interest has rolled out. It was 5 million ounces earlier this week. It's probably even less than that. That is no longer an issue. I think people are looking primarily at the idea of stronger investment demand for silver, along with stronger industrial demand in some applications like solar power. There are reductions in the um, government subsidies and supports for solar power in the big, beautiful budget bill. But that said, solar power now is at the point where it doesn't necessarily need those subsidies. People and corporations will continue to move towards solar power because it makes economic sense. So again, we're looking at silver prices moving higher in the longer term. Platinum and palladium continue to confound us. The price of platinum was up another $43 today to $1,455. You can see here on the left-hand chart that the price increase really began at the beginning of June, and it has continued into July. The right-hand chart is interesting and important because it shows you that, after a decade-long period of prices trading between, say, 800 and 1100 for the most part, we have now spiked up, and we're getting back to the point where we were in the middle of 2014 when the platinum price had come down and it was trading for the most part around 1400, a little bit above 1400 during a 6-month strike in the South African platinum industry. When that strike ended, the price fell below 1400, and it hasn't been back there until the last few days. So we're there. We're, as I said, a bit confounded because we don't see fundamentals pushing the prices higher other than investor and speculative, short-term investors and speculative purchases by investors and by trading companies that has emerged over the last couple of months. The platinum market's well supplied. If you need platinum, there's plenty of platinum out there. The auto industry is the largest use, and the auto industry is doing a little bit better this year, but not great. The largest market for autos is China, and in China, half of the automobiles are electric now that are being produced and sold are electric, and they don't use platinum. So you have a long-term secular reduction in platinum demand from its largest use. You also have cyclical weakness due to economic uncertainties and anxieties. People buying fewer cars. They're worried about tariffs effect on U.S. cars, prices, et cetera, et cetera. So you're not seeing strong fabrication demand. South African production is bumping along relatively unchanged. We're working on our Platinum Yearbook, which will be releasing 2 weeks from now on the final Tuesday of July. You're not seeing tightness in supply. There's plenty of platinum around. The price started moving after a marketing group issued a report that said there were massive platinum deficits. There are not massive platinum deficits. There's more platinum being refined from scrap and mine production than is being used on a fabrication basis. If you throw in dummy variables and you say that investors are buying a lot of platinum, you can say there's a deficit. But on a fundamental basis, supply less fabrication demand, you have a surplus in platinum. So there's plenty of platinum around, but these marketing people said there was a deficit and there was a big increase in Chinese platinum jewelry demand. They said about 100,000 ounces. We estimated it was about 32,000 ounces last year, a little bit higher this year. There have been increased imports into China and increased trading activity on the futures exchanges and in China for platinum. But we don't really see the fundamentals supporting platinum prices this high. And so our expectation is that at some price they'll fall back. At some point they'll fall back. And when that happens, we don't know. But we do not see a market fundamental rationale for platinum prices having risen so sharply over the last 6 weeks. And the same is true with palladium. Palladium prices have broken out of a channel that they've been in really since the end of 2023, and they've risen back there. We did see a spike up in October of 2024. We obviously saw a very big spike in February of 2022 when Russia invaded Ukraine, and there were concerns that there might be trade restrictions or sanctions on Russian platinum exports. Didn't happen. But we are seeing this strength in palladium seems to be coming along in conjunction with platinum. And again, we don't necessarily see fundamentals supporting prices at these levels. So our advice to our ultra short-term investor clients has been to stand aside. Now, people ask us, sometimes we get asked, what's the most common thing that you're being asked? And right now, the most common question that we're being asked is, what would cause gold and silver prices to either break up on the high side or on the lows, or fall below levels? And part of the question reflects the people saying, well, gold and silver prices are so low. Well, gold's at record levels right now, and silver is $38 is pretty high. It's not at record intraday levels, but on a quarterly or a monthly basis, silver prices are probably at record levels right now. So the prices are actually already high, but we understand the nature of the question. And our answer is, it won't be one thing. It's a combination of political, economic, and social problems becoming worse and financial markets becoming aware of that. And there's this enormous array of issues that are getting worse that could come to a head at any given point. On a domestic U.S. basis, on domestic policies and societal pressures in other countries, financial markets. We have a lot of the power that we've seen in terms of stock index increases has been concentrated in a few companies that are involved in artificial intelligence and the chips that go into that. And we're finding that artificial intelligence has severe limitations. But more importantly, we're finding that the artificial intelligence industry has been living off of investments into it. It's not a positive revenue generator. In fact, the profitability of these companies is probably highly suspect. So you have something of a house of cards in the stock market. You have interest rates that could go sharply higher, or if economic conditions worsen, or if economic conditions improve. There is been this wait to see if the Fed lowers interest rates, and our view is that the Fed most likely will lower interest rates over the next 6 months. Primarily because the economy will be in worse shape than it is today. We've already seen a 0.5 percentage contraction in economic activity in the first quarter. A lot of that had to do with a race to bring in imports ahead of threatened tariffs. We're waiting to see the second quarter. Our view is that the second quarter might eke out some positive growth because imports seem to be somewhat lower. But then in the second half, we might see 2 consecutive quarters of economic contraction, the classic definition of a recession in the United States, along with economic problems elsewhere. for a variety of reasons. It's going to be a combination of factors, and we have this enormous list of factors that we keep track of that could go better or could go worse. And our expectation is that they'll go worse over the next 6 to 12 months, and that will take gold over 3,500, and it will take silver over $40 for a ton. When you start saying, well, what could cause the prices to fall? It would have to be a better economic environment, a better international political environment, a reduction in domestic social and political hostilities and pressures. And quite frankly, all of those things have lower probabilities in our analysis than the negative alternatives. So our view is that the global economic, political, financial, and social world is skewing the probability toward higher prices rather than lower prices for gold and silver. Platinum and palladium, again, are industrial metals. They might follow gold and silver along, but they are more likely to be suffering from lower fabrication demand in a hostile economic environment. I'm going to talk a little bit about the dollar, because people keep talking about how the dollar's plunging. The New York Times and others got it wrong. They said the dollar is at the lowest level since 1973. What they meant to say was the decline in the dollar, the 10% decline in the dollar in the first half of this year, is the biggest 6-month decline in the dollar's exchange rate since 1973. I'll show you the chart in a second comparing the dollar exchange rate today to where it was in 1973, which was 2 years after the Bretton Woods gold dollar standard ended and the dollar entered what was then called a dirty float period. But you can see from this chart, which just goes back to 2020, that yes, the dollar has fallen on a trade-weighted basis. Trade-weighted basis is what matters for economic activity. Capital flows, the dollar, euro, dollar, yen, dollar, pound sterling are more important. But we look at it on a trade-weighted basis because we're looking at the real economy. And you can see here that the dollar has fallen sharply since January, and it's down back to the level that we have not seen since January of last year. Right? And it's up from where it was in 2021. It's still up sharply from where it was in 2021. If you look at it in a little bit more historical context, you can see that the dollar is 40% higher than it was in April 2011, as everybody was waiting for the U.S. Treasury to have its credit rating reduced, which happened in August of 2011. So the dollar has been doing pretty well over the last, compared to its performance over the last 20 years. And if you look at it from where perspective, this is 1973. We're pretty much where we were in 1973 in terms of a trade-weighted dollar exchange rate. Now, between 1973 and now, the dollar declined into 1978. It started rising in 79 and it rose into 1984. That's that big spike upward that you see there. Then it came down from 1985 into 1993 when the Clinton administration started cutting deficits and reducing deficits, ultimately leading to 4 years of surpluses. The dollar started rising again, and it rose from 1993 into 2002. Then it fell again, and it got down to that 2011 low. So you can see that the dollar around 110, 112 on a trade-weighted basis, this index basis, we're sort of where we were back in 1973. That's true. We're up sharply from where we've been for most of the time from 1986, 1987. So the dollar hasn't fallen. Now, why is that? Because everybody knows that the U.S. government is running like a drunken sailor. You know, have massive deficits and massive debt. The big, beautiful budget bill is going to add to the deficits by $3 to $5 trillion over the next decade by various legitimate estimates, and the debt will grow at an accelerated pace. It's no clear solution that the politicians in Washington will do anything to deal with that. So the U.S. Treasury is like the biggest sinner in a rush toward debt. And debt has grown enormously since 1971-73. We've seen a tremendous amount of debt grown. And the U.S. Treasury has been perhaps the biggest sinner, partly because the U.S. dollar is there. Why is the dollar so strong? Well, for a few reasons, but the primary reason is first off, you have a very strong competitive advantage in the U.S. economy. We have a lot of things going for us relative to other economies. We also have a comparative credit rating in the U.S. Treasury that is better, or it's competitive with other places. So as people look at a world that is facing tremendous economic and financial problems, they look for the least risky places to park their money. And the Treasury's debt is seen as less risky than most other sovereign debt, corporate debt, municipal debt. So the Treasury creates a problem, and as a result, everybody rushes into Treasury securities because they are the least risky place when you're facing that storm. So that's really what it is. But the other thing on this chart is, fortunately for gold investors, the relationship in month-to-month changes in dollar versus gold is only negative 34%. That means that 2/3 of the time, a stronger dollar is not a negative factor for a stronger gold price. You don't need a weaker dollar to see stronger gold prices. So don't sweat the dollar so much. That's all I have for you today. Take care. Take care of yourself. Take care of those around you. Take care of your community. Try to do something good for the world. You can go to our website. You can buy our gold and silver yearbooks. You can pre-order our platinum yearbook that comes out in less than 2 weeks now. You can buy other research from us, and you can send us an email at info@cpmgroup.com asking us to discuss with you how we can help you. Take care.